They boosted the economy for 2 years in the run-up to the Party Congress. So you were going to see some steam off the engine. There was going to be a weakening of growth regardless. But what Trump did with his tariffs is pull a lot of the growth forward and really scare them in terms of what might happen in 2019. So people, for the first tranche, they pulled growth forward, and it weakened it afterward. And then they pulled more forward, and they talk about the $200 billion, and then talk of even $267 billion in tariffs. People keep pulling this growth forward, and so you have a weakening effect. But our data show that manufacturers have been doing very poorly, and that's before the tariffs have even hit.
Well, that's my question. So how much are we supposed to read into the tariff situation versus what's actually just happening on the ground in China?
I think you have weakening, but the tariff situation has created a very bad potential problem for China. Fourth quarter this year, potentially a big way first quarter. If this ramps up January 1st, the Chinese economy will be hurting very badly, even with some of these other growth engines not doing as poorly.
Okay, so when did the sniffles turn into a cold for the rest of us? Rick was talking about how this now represents, what did you say, 40%?
The growth. Yeah. 40% of dollar, of dollar growth. Yep.
Dollar growth.
I think Jan 1 is absolutely pivotal, because I think if we see a pullback at the G20 meeting next month, markets are going to be very happy with that. They're going to see this as it won't be a reversion to the status quo ante, but it could be a de-escalation of the tariff ramp up on January 1st. If you see that, I think that this will be very reassuring to markets.
Okay, so the temporary measures that the government's taken effectively over the weekend, stock now popping today.
Right.
What do you think they actually did?
Well, they did what they always do. They just waited a lot more time to do it. So if you look back in 2015, they had a very active national team. They jumped in too soon. You had the Greek mess hit, so a bigger extraneous exogenous event had happened, and it blew right through the national team levels. So they waited longer than they wanted to this time, but now they came in and they said, look, we will defend the economy, and that's what you're seeing right now. And consumers and investors had been looking at that as a cue, and they got their cue, so they're very happy.
Hey, Leland, let's talk a little bit about longer term, what some of these tariffs might mean. We just had Jim Weber here. He's the CEO of Brooks Running Shoes. They manufacture about 50% of their shoes in China. They are now looking very actively to move. He said they'll probably move to Vietnam. And that once they do that, those jobs are gone. They're never coming back.
Right.
What are the long-term implications? We've heard Jack Ma talk about long-term, this could be a 10-year issue between the United States and China, but what are the long-term implications for China if those suppliers or if these companies that source move offshore?
Well, that's exactly the problem. The long-term implications are a fundamental decoupling of the two economies. And I think we can actually separate that from whether we have a trade deal pause at the G20. Too many people are conflating short-term deals, long-term deals. Yeah. Whether or not we have some sort of pause on tariffs next month, that's totally separate from the fact that the two economies are working. And this is under President Trump now. It'll probably be under the next two presidents in the United States, moving away from having China-sourced production. And you will see this separate. So we called it the bifurcation of globalization, because we think that they are going to decouple the economies in very serious ways. And once you go that direction, you're not going to be able to reverse it. Right?